Return on equity is a financial goal that can become an own goal. Maximize return on equity. Many stock market analysts regard return on equity, ROE, as a vital measure of business success. ROE measures profit as a percentage of the shareholders' equity on the balance sheet. This equity is comprised of share capital, capital raised from selling shares, and reserves, the company's accumulated, retained profit. ROE is affected by trading conditions. Still recovering from a tsunami and floods, Toyota achieved an ROE of 3.9% in 2012. Rival General Motors, GM, unaffected by the natural disasters, managed 16.7%. Based on its ROE, GM appeared to be 4 to 5 times better at generating profit from shareholders' investment. A misleading measure. As an indicator of investment potential, ROE can be problematic. The percentage outcome is a function of two things: how high the profit is, and how low the shareholders' equity is. Toyota and GM both made a similar pre-tax profit in 2012, but the amount of shareholders' equity in the two companies creates a misleading picture. Toyota has a huge balance sheet with high shareholder equity, bolstered by decades of high profits. GM's bankruptcy in 2009 had wiped out its reserves, leaving it with a small equity base. GM's high ROE was largely due to its collapse and U.S. government bailout. In the 2000s, many banks cut their balance sheets through share buybacks. Cash was used to buy shares back from shareholders, reducing the equity at the bottom of the formula. This increased the ROE, but led to a risky capital structure. By maximizing ROE, the banks left too little cash to deal with the 2007-08 financial crash. ROE is calculated by dividing profit by average shareholder equity. The higher the figure, the more efficient the company is at generating shareholder returns. In context. Focus, business goals and risks. Key dates. 1978 legendary investor Warren Buffett claims that ROE is not likely to stray from a level of 12% for very long. 1995 The Warren Buffett Way by Robert Hagstrom introduces the public to Buffett's approach to investment, including the importance he places on ROE. 1997 The U.S.'s S&P, Standard & Poor, Index of Industrial Companies reveals an average ROE of 22%. 2012 Among international clothing retailers, ROE varies from 40% at Gap and 39% at H&M, to -139% at American Apparel. Based on its ROE alone, American Apparel should no longer exist in its current form.